Silver has been making headlines all around the world after its biggest price surge in years, climbing from levels around $30 a year ago to above $100 per ounce this month. On December 29, it hit $70 per ounce in New York, but in Shanghai, it was $83 per ounce. Elon Musk responded, "This is not good." This remarkable rally reflects a mix of supply constraints, a strong industrial demand, and shifting global policies that are putting pressure on the silver market in ways we haven't seen before. From a physical shortage to a liquidity squeeze, concerns over China's new export rules and supply bottlenecks are pushing prices sharply higher. In this video, we are breaking down what is happening with China and silver, why this matters to you even if you never invested a single ounce of silver in your life, and how the global tech and manufacturing industry are affected. Why silver is so important. Before we get into what China did, it's important to understand why silver matters in the first place. For a long time, silver has been viewed mainly as jewelry, coins, or a secondary precious metal that follows gold. That view no longer reflects reality. The way silver is used today explains why pressure in this market quickly turns into extreme price moves. Silver is one of the most critical industrial metals in the modern economy. Nearly every piece of technology people use on a daily basis relies on it in some form. Smartphones, laptops, vehicle, household appliance, medical equipment, industrial machinery, and power system all contain silver. The reason is performance. Silver is one of the most electrically conductive metals on Earth. It allows electricity to flow efficiently with minimal resistance, which is essential for electronics, power transmissions, and precision components. Silver also performs reliably under heat and stress. That makes it valuable in environments where failure is inexpensive or danger, such as data centers, power infrastructures, renewable energy systems, and advanced manufacturing. Industrial demand for silver has climbed steadily for years and recently exceeded 680 million ounces annually. That demand comes from electronics, electric vehicle, solar panels, expanding electrical grids, and digital infrastructure. As economies electrify and digitize, silver demand rises alongside them. This demand does not disappear when prices rise because the system that relies on silver still needs to function. Silver is not a niche material or a luxury metal. It sits inside the system modern life runs on. And once you understand how dependent those systems are on silver, the next question becomes unavoidable. What happens when that silver is not easy to replace? No easy substitute. Rising prices only become dangerous when markets lose flexibility. If manufacturers can easily switch material, shortages tend to resolve themselves over time. Silver does not offer that flexibility. Silver is difficult to substitute without sacrificing performance, efficiency, or reliability. Cheaper metals conduct electricity less effectively and generate more heat and degrade faster over time. In electronics and energy systems, those trade-offs matter. Lower conductivity means higher resistance and more heat buildup and a greater risk of failure. Over time, that leads to maintenance problems and shorter product lifespans. From drones and computer, renewable energy equipment, and electric vehicle, silver is used because it works consistently. Once systems are designed around it, replacing silver often requires redesigning entire components or products. That process is slow, expensive, and sometimes impossible at scale. As a result, demand does not fill quickly when prices rises. Instead, buyers compete for a limited supply. Because silver cannot easily be replaced, supplier pressure doesn't fade, it builds. And that rigidity helps explain why silver behaves so different from other metals, especially when you compare it to gold. Silver versus gold and the dual role. Silver is often discussed alongside gold, but the comparison hides an important difference. These two metals respond to stress in very different ways. Understanding the difference helps explain why silver prices tend to move faster and further. Gold is primarily treated as a store of value, invested by gold to hedge inflation, preserve purchasing power, or protect against financial instability. Its demand is largely financial. Silver plays a dual role. It is both an industrial input and a monetary metal that ties its price to real economic activity and investors behave at the same time. Silver is also more volatile. It is often described as a higher beta version of gold, meaning it amplifies broader trends. When markets are calm, silver can lag. When stress appears, silver often overreacts. Because silver is pulled by both industry and investment demand, supply problem hit it from multiple directions at once. This has left silver in a persistent supply deficit. Global mine production has failed to keep up with total demand for at least 5 consecutive years, leaving the physical market structurally short. Silver reacts more aggressively to stress because it sits between industry and finance. And when market like that runs short for years, it only takes a small push for prices to move much faster than people expect. The structural supply deficit and price breakouts. Markets that operate in a deficit for long periods become very fragile. They do not need a major crisis to break, they only need one more source of pressure. In late 2025 and early 2026, silver repeatedly broke major price levels. It moved above $95 per ounce and then surged past $100, a milestone not seen in decades. This move was not driven only by traders chasing momentum, it was driven by real shortages of physical silver and rising demand from manufacturers trying to secure future supply. As inventories tightened and delivery timelines became less predictable, buyers moved early and more aggressively to lock in material. Sellers demanded higher prices to compensate for risk. Future markets began pricing future scarcity instead of the current availability. This is how commodity markets behave when confidence in supply weakens. Once prices start moving under this condition, volatility increases. Small disruption cause outsized reactions because there is no buffer left in the system. When a structural supply deficit meets rising demand, prices move, stop being speculative and start become defensive. And at that point, the real question is no longer demand, but where the pressure in the supply chain is coming from. China as the choke point. The most important pressure point in the silver market is not mining, it's refining and export flow. This is where China becomes central. At the start of 2026, China expanded its silver export licensing regime. Under this system, only approved companies are allowed to legally export silver during the 2026 to 2027 period. The stated goal is to protect domestic supply for key industries such as electronic, renewable energy, and advanced manufacturing. These sectors require reliable access to refined metals, and China has made securing that access as a priority. China already played a major role before these changes. While it represents a modest share of global mine production, China refiners process a large portion of the world's refined silver and ship it globally. Licensing rules add administrative friction. They slow export, complicate logistics, and create uncertainty without imposing formal bans. Some data show that China still exported large volumes of silver in 2025, suggesting market stress is not only about restrictions, but about tight supply and confidence in the future availability. When a choke point controls the refined supply, even modest policy changes ripple through the entire market. And those ripples do not stay inside commodities, they move outward into the real economy. Why this hit everyday life? Market stress does not stay on trading screen forever. Over time, it works its ways into everyday systems. Silver's role in modern technology makes that unavoidable. As prices rise and supplies tighten, industries adjust. Companies hedge future costs, build larger inventories, and redesign supply chains where possible. These steps reduce flexibility and increase expenses. Governments respond as well. Many countries as reassessing access to critical materials, not just silver but rare earth and other strategic metals. India, for example, has become one of the world's largest importers of silver to secure supply for manufacture and technology. For consumers, the impact is indirect but real. Higher input costs can lead to more expensive electronics, slower upgrade cycles, and price increases spread over time. Because silver is embedded in so many technologies, cost pressure accumulates quietly rather than appearing all at once. When a metal that sits inside an everyday system becomes scarce, the impact eventually reaches everyone, not just traders and manufacturers. Silver prices are not going crazy by accident. They are reacting to pressure that has been building for years and to a decision China made that changed how these markets function. When materials that modern lives depends on become harder to move, the effects do not stay contained. They spread slowly, quietly, and broadly. That is why silver matters, even if you never plan to own a single ounce of it. If you like this video, please like and subscribe. If you want to protect your money against inflation and see how I did it? Watch this video.